Hello, my friend. So, you've decided to sell your Hawaii property. You've got the palm trees, the ocean view, and a buyer lined up. You're mentally spending that check on a luxury cruise, or maybe just a really nice glass of wine. And then you hear it. That terrible 6-letter acronym that sounds like a tropical throat infection, HARPTA. I'm Jason Wong with Island Dragonfly, and today we are revisiting the beast that is HARPTA. We're doing a deep dive, cutting through the rumors and explaining why the state of Hawaii wants a chunk of your money before you even leave the island. And don't worry, I'll tell you how to get it back. First, let's clear up the biggest lie on the internet. HARPTA stands for the Hawaii Real Property Tax Act. But here's the sassy truth. It is not a tax. I repeat, it is not a tax. It is a withholding. Think of it as a security deposit for the state of Hawaii. The government knows that once you sell your house and move to Vegas or Texas, you might forget to file your final Hawaii income tax return. So instead of trusting you, they effectively take your money hostage at the closing table. Here is the revisited deep dive on the numbers, because this is where people cry. Under Hawaii Revised Statutes Section 235 to 68, if you are a non-resident of Hawaii, the buyer is required to withhold 7.25% of the amount realized. Now, pay attention. I said amount realized, the sales price, not your profit. Let's do the math. You bought a condo for $800,000. You sell it for $800,000. You made zero profit, zero capital gains. Does Hawaii care? Nope. They will still withhold 7.25% of that $800,000. That is $58,000 pulled right out of your pocket at escrow. Ouch, right? Now, if you actually live here, like you file Hawaii resident taxes, you vote here, and you know the difference between Mauka and Makai, you are safe. You simply fill out Form N-289. That's the I live here, please don't rob me certificate. You hand that to escrow and boom, no withholding. But if you live in California and this was your vacation rental, sorry, you're paying up front. Okay, Jason, so they took my $58,000. How do I get it back? You have 3 options ranked from slow to pro. Option 1. The slow boat. Wait until the end of the year, file your N-15 income tax return, prove you didn't owe that much tax, and wait for a refund check. Bring a book, it takes a while. Option 2. The I lost money plea, Form N-288B. If you are selling at a loss or zero gain, you can file Form N-288B before you close. You are basically asking the state for a permission slip to skip the withholding. But be warned, you need the state's approval in writing before escrow closes, or they have to withhold the cash anyway. Option 3, the Give It Back Early request, Form N-288C. This is the revisited hack. If escrow already took the money, but you don't want to wait until next year's tax season, you file Form N-288C for a tentative refund. It's like saying, hey, Department of Taxation, you took too much, check my math and send it back now. One quick side note for my international clients. If you are not a US citizen, you have a double whammy. You have HARPTA, state level, 7.25%, and you have FERPTA, federal level, usually 15%. That's a total of 22.25% of your sales price held back. If that's you, call me immediately. We need to strategize. Look, HARPTA isn't a penalty, it's just paperwork with high stakes. You need a team that knows the difference between an N-288 and a hole in the ground. Whether you're selling a condo in Kaka'ako or a beachfront estate, don't let the taxman surprise you. I'm Jason Wong. Let's sell that house, keep your equity, and stay out of tax trouble. See you next time, my friend.